In this video, I will explain an asset revaluation and deferred taxes arising in a revaluation. For this purpose, I created an example. William Limited acquired on 1st of July X5 a machinery with a 10-year useful life for $100,000 that has no residual value. Accounting uses straight line basis and taxation uses 20% per annum straight line basis of depreciation over the useful life with no residual value. On 30th June X9, that is 4 years after, machinery was revalued to $130,000. There is no residual value, but the total remaining useful life was then re-estimated as 4 years. William Limited continues to use the asset. Income tax rate is 30%. William Limited has up-to-date deferred tax balances up until the revaluation. So first, we'll ascertain the deferred tax liability balance prior to revaluation on 20X09. Second, we'll provide journal entries resulting from revaluation 30 June 20X09. Third, we provide journal entries for depreciation and deferred tax for 30 June 20X10 and do the same 30 June 20X11 and repeat the same 30 June 20X12 and 6. Repeat the same 30 June 20X13. So our first task is to ascertain the deferred tax liability balance before undertaking revaluation as at 30th June 20X09. In accounting, the cost is $100,000. It's depreciated over 10 years with no residual value. The depreciation expense for a year is $10,000. For 4 years is $40,000. The carrying value is $100,000 less $40,000 equals $60,000. For tax, cost is $100,000 depreciated over 5 years. Therefore, tax depreciation is $20,000 a year. For 4 years, it is $80,000. Tax base is $100,000 less $80,000 of tax accumulated depreciation equals $20,000. So this gives rise to a taxable difference of $40,000 because carrying value is $60,000 and the tax base is $20,000. Because there is future expected cash inflows from $40,000, the future tax liability or the deferred tax liability becomes 30% of $40,000 and that's $12,000. So that becomes the deferred tax liability balance as at 30th June 20X09 before the revaluation is undertaken. Then the revaluation is undertaken on 30th June 20X09 and under the net method which is used here, we have to reverse the accumulated depreciation into the machinery account. So therefore, we debit accumulated depreciation of $40,000 and transfer that to the machinery as a credit $40,000. So that makes the machinery account equals to the carrying value because there's $100,000 of cost and then now there is a credit value of $40,000 the difference becomes $60,000 of carrying value in the machinery account. The machinery account is now revalued. The total value should be $130,000. Therefore, the value increase is $70,000. So we increase the machinery value, and the corresponding increase is the revaluation surplus, which goes through the other comprehensive income. Because revaluation surplus is stated after taking off the tax, we have to adjust for any taxation impact. So to determine how much it is, first we have to look at the deferred tax liability balance it should be. So we start with the revalued cost of $130,000 and the tax base was $20,000. So the new deferred tax liability balance should be based on $110,000, which is the difference between $130,000 and $20,000, $110,000. Second, we have to now record the journal entries at the time of revaluation at 30th June 20X09. Prior to revaluing the machinery, under the net method of revaluation, we have to transfer the accumulated depreciation into the machinery account so that the machinery account represents the carrying value. So therefore, we transfer $40,000 from accumulated depreciation into the machinery account. Now the machinery account will have $40,000 on the credit side, and with the cost of the machinery, which is $100,000, the difference is $60,000. The machinery is now revalued to $130,000. Therefore, we need to increase the machinery value by $70,000, and the corresponding increase is the revaluation surplus. And the revaluation surplus is stated after tax. To find out how much of tax that has to be taken off from the revaluation surplus, so we look at the revaluation cost. Revalued cost is $130,000, which is the new carried value, and the tax base is $20,000. So the new deferred tax liability balance should be $110,000 into 30%, which is the tax component, and that is equal to $33,000. But there is a previous balance of $12,000 which we found prior to revaluation. Therefore, what we need is an additional deferred tax liability balance increase of $21,000. So therefore, we are now increasing the deferred tax liability balance of $21,000 with a corresponding decrease in the revaluation surplus of $21,000. Third, the journal entry is 1 year after revaluation, that is 30th June 20X10. 1 year after, there is depreciation expense resulting from the revalued asset. The revalued asset is $130,000, but the remaining useful life is re-estimated as 4 years. Therefore, the depreciation expense is $32,500, which we record with a corresponding entry for the accumulated depreciation of $32,500. When depreciation expense is recorded, the expenses increase and the profit decrease. When the profit decreases, the income tax expense also decrease. So 30% of 32,500 is 9,750. So we show the decrease in income tax expense 9,750, and the corresponding decrease is on the revaluation surplus of 9,750. So what's really happening here is, because the asset is now used for a year, there is cash inflow generated from the asset. When cash is generated in this period, or income is generated in this period, there is an effect on the profit. Profit is on the credit side. So the income tax expense, which is a credit amount of 9,750, is representing that increase in the cash inflows from the asset use. That cash inflow, which has occurred now, is as a result of the cash inflow withheld, or the future cash inflows that is recorded in the revaluation surplus. So from the revaluation surplus, that future cash inflow is now released as the current cash inflows. So therefore, revaluation surplus is decreased and income tax expense also decreased, which effectively is increasing retained profits. We also have to now record the deferred tax liability, the impact on deferred tax liability. The carrying value of the asset is now, revalued cost is $130,000, and accumulated accounting depreciation is $32,500. That equals to a carrying value of $97,500. The tax base of the asset is now, it is in the 5th year. The asset is now fully depreciated for tax purposes. Therefore, the tax base is 0. So therefore, the temporary difference, tax difference is $97,500. The new deferred tax liability balance is 30% of that $97,500 equals $29,250. The previous deferred tax liability balance is $33,000, and the deferred tax liability balance now has to be stated as $29,250. So effectively, you need to decrease the deferred tax liability account by $3,750, and that becomes a credit on income tax expense $3,750. Fourth is journal entries to record 2 years after revaluation, that is 30th June 20x11. Again, there is depreciation expense, which is on straight line basis. For a year is $32,500. So we record the depreciation expense with a corresponding accumulated depreciation of $32,500. The revaluation surplus now again is decreased, because part of this revaluation surplus now becomes future cash of the revaluation surplus, now becomes present cash inflows. The tax effect of the $32,500 is 30%. Of $32,500 is $9,750. So we have a debit of depreciation expense $32,500. That's going to decrease profit. When the profits are decreased, income tax expense also decrease. So income tax expense we decrease by 9,750, and the corresponding side is the revaluation surplus of 9,750. So like in the previous scenario, the future cash inflows embedded in the revaluation surplus is now being released into the to the current period by the asset use as retained earnings. So income tax expense, which is a credit balance of 9,750, effectively is representing the retained profit after tax that has increased by 9,750. Revaluation surplus decrease and the income tax expense decrease, effectively that is increasing the retained profits. Next is for us to account for the deferred tax liability. Again, we have to look at the carrying value of the asset. We start with the revalued cost of 130,000, and accumulated accounting depreciation is 32,500 into 2 years, that is 65,000. For tax purposes, the tax base is 0 because it is fully depreciated for tax purposes, and the temporary tax difference becomes 65,000. Because 130,000 less 65,000, that difference carrying value becomes 65,000. The new deferred tax liability balance is 30% of 65,000, or the tax effect of that temporary tax difference, which is 19,500. But the previous deferred tax liability balance is 29,250, but we have to now break it to 19,500, which means we need to decrease the deferred tax liability balance by 9,750. So therefore, we debit deferred tax liability balance 9,750 with a corresponding decrease in income tax expense of 9,750. Fifth, the journal entries 3 years after revaluation, that is 30th June 20x12. Again, we have to record the depreciation expense. It is on straight line basis. For a year, depreciation expense is 32,500. So we record the depreciation expense with a corresponding recording of the accumulated depreciation. The effect of we having the depreciation expense is we are increasing the expenses, we are decreasing profit, and our income tax expense decrease by the tax effect of that is 30% of 32,500 is 9,750, and our revaluation surplus also decreased by 9,750. Again, as in the previous scenarios, the future cash inflows are now released in the current period, and that amount is 9,750, and the credit income tax expense is effectively retained profits or profit after tax of 9,750. That's going to increase the retained profits. We have to adjust the deferred tax liability balance because the deferred tax liability, because the asset has been used, the deferred tax liability also should decrease. So we have to first look at the carrying value of the asset. The revalued cost is 130,000, but the asset has been used for 3 years, and the accumulated depreciation is 97,500. So the carrying value is 32,500. The tax base is 0 as it has been used for 5 years. Therefore, the temporary tax difference is 32,500. The new deferred tax liability balance becomes 30% of 32,500, 9,750. Our previous deferred tax liability balance is 19,500. So the deferred tax liability balance must now decrease by 19,500 less 9,750, which equals to 9,750. So we decrease deferred tax liability of 9,750 and we decrease the income tax expense of 9,750. 6. A journal entries 4 years after revaluation, that is 30th of June 20x13. Before we do those journal entries, I would recap what we have done so far in relation to deferred tax liability balance and revaluation surplus balance. So 20x09, we had deferred tax liability balance of 12,000 before revaluation, and then for the year, because of the revaluation of the asset, we increased the deferred tax liability by 21,000 because we increased the carrying value of the asset, and the year in balance became 33,000. Then during the year 20x10, we decrease the deferred tax liability balance by 3,750 due to the asset use, which resulted in the decrease of the deferred tax liability balance. On 20x11, again because of the asset use, we decreased the deferred tax liability balance by 9,750. That resulted with an year-end balance of 19,500. In 20x12, we again decreased the deferred tax liability balance by 9,750 because of the asset use, and we ended up with year-end balance of 9,750. And during the year that we are going to look at, the deferred tax liability decreases by 9,750 with an year-end balance of 0 because the asset is now, by end of 20x13, the asset will be fully depreciated with no residual value. When it comes to revaluation surplus, what we did was that we had a revaluation surplus because of the asset revaluation, $70,000, and we decreased that revaluation surplus by $21,000 because of we have to state the revaluation surplus excluding tax. So we ended up with a year-end balance after revaluation surplus of 49,000. And during the year 20x10, we decreased the revaluation surplus by 9,750, and we ended up with a balance of 39,250. So that became retained earnings of 9,750. Again in 20x11, we decreased the revaluation surplus by 9,750, and we ended up with a balance of 29,500. And 20x12, we decreased the revaluation surplus again by 9,750 and ended up with a balance of 19,750. And 20x13, again we decreased the revaluation surplus by 9,750, and we ended up with an year-end balance of 10,000. So there are two things here that we need to acknowledge. So once the asset is fully depreciated, we are ending up with a revaluation surplus balance of $10,000. So once it is fully depreciated, there shouldn't be a revaluation surplus for that asset, so that that remaining balance should now be transferred through other comprehensive income as retained earnings. And the second thing we have to notice and acknowledge, a deferred tax liability balance, once the asset is fully depreciated, in accounting and tax, we end up with a zero balance, because deferred tax liability balance is about a temporary phenomenon. And any deferred taxes that has been generated at the beginning then is phased out over the years, and ultimately they disappear. So let's do the journal entries now. Our first journal entry is to record the depreciation expense, which asset depreciated on a straight line basis is 32,500 depreciation expense and accumulated depreciation. Depreciation expense increases the expenses, decreases profits, and therefore income tax expense should be decreased by 30% of 32,500. That equals 9,750. 9,750 as a decrease in income tax expense, and the corresponding entry is a decrease in revaluation surplus. As in previous scenarios, the future cash flows embedded in revaluation surplus is now released in the current period, and that amount is 9,750. That credit of income tax expense is effectively an increase in retained profits, because retained profits or revenue, all those are credit items, credit balances. So effectively it increases the retained profits. Our next entry is to account for the deferred tax liability. To do that, we have to look at the temporary tax difference and the new deferred tax liability balance and the previous deferred tax liability balance. So the carrying value of the asset is zero, because revalued cost of 130,000 is now fully depreciated over 4 years, which is 130,000. Tax base of the asset is zero, therefore the temporary tax difference should be zero. New tax liability should be zero. The previous deferred tax liability balance was 9,750, therefore nothing should be there. So we debit or we decrease deferred tax liability balance, and we credit income tax expense 9,750. So we decrease the deferred tax liability balance, and we also decrease the income tax expense. Our final entry is transferring the remaining revaluation surplus to retained earnings. The remaining amount that is sitting on the revaluation surplus is $10,000. So we now transfer that to retained earnings through other comprehensive income, and that's $10,000. We look at the deferred tax liability balance and the revaluation surplus balance. We can notice under the deferred tax liability balance that the year-end balance at 20x09, that is the balance after revaluation, is $33,000. And when we look at the decreases in the deferred tax liability balance that becomes decreases in income tax expense, or that increases the retained profits, because they decrease the income tax expense, which is a credit amount. They increase the retained profits. When we add up all those amounts, that equals to $33,000. That $33,000 comprise $21,000 of the deferred tax liability balance that we increased because of the revaluation, and prior to that there was $12,000 balance of deferred tax liability. All of them are now being transferred and has become retained earnings. But we have to acknowledge when they became retained earnings, they are also having a deferred tax liability balance of $12,000, which is before the revaluation. So let's look at the revaluation surplus now. The 20X09, the year-end balance after revaluation is $49,000, and that $49,000 is gradually released as a decrease in income tax expense or increase in retained profits, because they are credit balances. Retained profits of $9,750 over 4 years, that equals to $49,000. So if we add up $49,000 plus $33,000, so the $49,000 and $33,000 are the ones that become retained earnings. So this retained earnings of $49,000 due to revaluation surplus that is now being transferred gradually into retained earnings. So that is $9,750 into 4 years, that's $39,000 plus the last $10,000, and that is $49,000. And then there is also, if you look at the deferred tax liability balance, that $33,000 is also gradually transferred into retained earnings as credit in income tax. So if we add up $33,000 and $49,000, that equals $82,000. But that $82,000, that also include the deferred tax liability balance prior to revaluation of $12,000. So if we take off that $12,000 from the $82,000, so $70,000, which is the revalued amount, has now become retained earnings. The total revalued amount has become retained earnings, and that has become retained earnings as partly through deferred tax liability balance being released as retained earnings, and partly revaluation surplus being released as retained earnings. So this brings us to the end of the video, and thanks for watching. I am Professor Indra Besekara.